valuation is not an exact number. If you say my business is worth, say, 10 shillings, you should have a range. You can't say if I'm not getting 10 shillings, that's it. There's a range because it's not an exact science. Because the way you view your business could be different from the way the investor is looking at your business. And that's something we're going to go into. Have a range, talk with your advisor and say, the minimum I can accept is 8. And if I'm accepting 8, I'll need this and this requirements. Maybe you'll want to climb back more. But if the investor can give me 10, then I'm willing to give up some of these other issues. So it's important to understand that during valuation, you should always have a range of expectations. Then, of course, the legal documents, which we will go through in detail much later. And yeah, so for impact investing, one of the key things to understand is they'll focus a lot on ensuring that you have those impact aspects. So if you say, we help, we create like 500, 200 jobs a year, explain. You'll have to work how you come to that number. So for example, we're very concerned about the environment. We make sure we are employing the latest technology. They'll want to verify that, and it'll work its way into the term sheets. Banks, for a commercial bank, very simple. You go, you're given an application form, fill in the application form, give in the supporting documents, submit to the relationship officer. The relationship officer submits to the credit committee of the bank. They agree, okay, can we give, how much can we give? Is there collateral? Nowadays, collateral just doesn't cover yourself. Sometimes it's almost 2 times or even 3 times your collateral, depending on how their perceived value is. And if you're able to sign off on the term sheet and on their letter of offer, they go, they perfect your security. Money is disbursed. Keep paying your interest payments, then pay your principal and interests. So long as you're paying, there's no problem. Simple, right? But it's collateral based, and not everyone has collateral. And that is why we are coming here to say what other debt is there. So we've mentioned private debt, and he talked about BPI as one of them, Business Partners International. So essentially, the process goes similar, but because it's private debt, and they might not be focusing on collateral as 100% cover, they will take more time to understand you, the entrepreneur, and the business. So one of the key things I'd like to highlight is they will do some due diligence, unlike the banks. The banks might come, take a visit maybe once or twice just to confirm your factory really is there, these are your people, you know, things like that. But the private debt person will want to understand you, the entrepreneur, and the business more in detail. He's mentioned that BPI do psychometric tests. They're focusing on the entrepreneur because they're saying, we've looked at all the risks and we think the entrepreneur is the highest risks. So, because we don't know you, we've not grown up with you, we've not lived with you, here is a test that should tell us 2 or 3 things about you in terms of your personality, what you're likely to do in certain scenarios. If we fund the business, are you likely to take off with the money and go to the Bahamas? Things like that. Other due diligence that may happen is commercial. If I'm lending you and I don't have collateral, I want to better understand how your business is making money, right? So for example, you're buying your raw materials from Subut. Subut gives you supplier financing. What's the time frame for that? Then you're supplying very big projects, delays in the projects, things don't kick off on time, order quantity mismatch. Sometimes some project contractors cut corners by ordering the wrong amounts, they don't ask for the right consistency, or the team is not good. So there are so many risks in terms of where you can lose money that impact your estimated cash flows. Never underestimate the value of the team. Because the investor, and we were joking about this with Masood, the horse we like, the jockey is critical. Because you can take that same horse and give a different jockey and have different results, right? So we could like the horse and we like the jockey maybe to run only 1 race. Because we know after 1 race, that jockey cannot take this business further. So we'll need to bring other jockeys. So the team, it's important for you to have a team, not just, yes, the founder, you're critical, you're the vision bearer, you're the person who is growing this business. But like we had with Vikas this morning, you can reach a point where, as opposed to being a strong point for the business, it's a stumbling block because you're doing everything. You have a good team, but the capacity for the team to be able to operate at your same level is not there. And neither is there a path for the team to grow to that. So even if you're in, say, like now Uganda and Rwanda, I believe, yeah, there are certain aspects where it's still the same founder who has to come and sort it out. And then if he's away for a week, a month, certain aspects will stall. So it's important for you to think about your team and execution capacity, experience. So for example, I like the fact that you mentioned most of schools nowadays that started, they weren't started by teachers or people in education. People just started them and liked them, and then they grew with them, and then they got to love the education sector. So there are certain sectors where if you're starting a business, say I want to build Uber. I have no transport experience, I have no tech experience. What am I bringing to the table? I know how to raise money. Okay, well, that's good, but you're not going to run the business, right? So you need to have a team that reflects the core competencies of that business. Currently, where I am, I'm only able to generate X in terms of retained earnings. But if I really want to achieve this milestone in year 2, I'll need extra funding. And if I want to achieve in year 2, 3, 4, 5, maybe I can achieve milestone 2 with debt. We discussed this. But if I want to get to a point where I'm able to ramp up without having start and stops, I might need that money in lump sum. And that's where this alternative financing comes in. So the way we look at it from an investor perspective is, you've said this is your growth strategy. And we said no happy numbers. Because your numbers are not for the investor, they're for you. Because whether the investor is there or not, you need those projections. So forget happy numbers, realistic numbers. And remember, we talked about base case. In a good scenario, if things happen as I want, I'm likely to hit this target. If the market goes against me, or I'm not able to reach the customers I want or onboard the students I want, I'll probably not do well. I'll probably do at this level. Or if everything works spectacularly, a miracle happens, I'll outperform. Like I said, it is rarely the case, but hey, things happen. So once you know what your strategy is, break it down into milestones. And why do we insist on this? Because it helps you think through what the process is. So for example, Brian decided, I want to expand my operations to Tanzania in year 2. There's a process because of the way his business is structured. You'd need to think about, first and foremost, land. Not only availability, acquisition, how to work it, how to acquire, am I leasing, am I buying, what are the legal requirements. Other structural concerns. How am I going to be running the business if I'm the sole entrepreneur and I want to do Tanzania? Who are my competitors in Tanzania? What are the logistics like for Tanzania? Can I get land next to the airport so I'm able to quickly get my stuff onto a plane? And thinking through milestones is important because people tend to do strategies in the air. Oh, next year we will do Tanzania, we'll do Zambia. You've not really thought about how you're going to get into that country. And he talked about it. Are we acquiring? Are we starting from the ground up? What does the competition look like? What are the logistics involved in having people in Tanzania? If I invest there, can I easily bring my money back to Kenya? Are there double tax requirements that will hit me on both sides? So you need to think about that. So once you know your milestones, break it down into the funding requirements. And we always have a laugh about this. Most entrepreneurs put the entire funding requirements there. And then I ask you, your business has not stopped. Your business is still running, right? The investor is not going to come and replace everything. Some money you'll get from retained earnings. Remember, we discussed that we are not raising more money than we need, because when you raise more money, there's an upside that you give. So look at what your business can fund and then look and critically say, what is it that I want the investor to look at? And then just very quickly as an overlay, an investor will probably be thinking, okay, this is what he wants to do, all right? These are the funding requirements, okay. So if I invest, if ASIF invests, if I give them $1 million, how long will it take them? And that's the calculation he's doing. He wants to know, if these are your funding requirements, I give you $1 million. If it takes you till here, okay. If it only takes you to here, problem, maybe. Because that means in year 2, you're going to want more money, and maybe I can't give you more money. So as an entrepreneur, you need to think that through that. How much money do I want? The investor is thinking, how far will this take you? So when you're going to look for investors, you need to understand, when I raise your money, you need to tell him, it's going to take me to maybe year 3, year 4. And then that's a conversation you need to understand. Will he be able to follow on, give you more money? And if not, are you both comfortable with the idea of going back on fundraising? Because it takes time. Right, so for the pitch deck, I'm not going to get into many details because I want us to do a quick exercise. So these are basically the sections that you'll have in your pitch deck. The summary is just a very quick way for the investor to know, can I understand this opportunity and business model? I can't tell you how many times you've looked at a pitch deck. You're on slide 10 and you still can't tell what that business does. I'm like, I don't know, I can't tell. Due diligence, why it's important. We all know why there's due diligence, commercial, financial, legal. It's because, one, what the investor is expecting is it's time sensitive and it's costing him money. So be prepared. 2, if there's something wrong in your business, as advisors, we always say, find a way of framing the skeletons in your closet. It's easier for you to tell me, and frame the issue. I have issues with compliance to phytosanitary, but this is what I'm working on. As opposed to keeping quiet, and then when the investor finds out about it, then it becomes a huge issue. So bring up your skeletons. Don't try and hide them, because they'll always come out, and it creates an element of mistrust. Commit to the work plan. Allow people access to documents. So have your documents and everyone ready. If they need to speak to management, have the management present and ready so that they don't end up spending more time. Please have your documents to be the latest and most up-to-date. So many times we get a document, no, that's not the one. It's revised. Then the revised policy was never signed or passed by a board or things like that. So it's important to have that. So why is the investor doing this? A, to confirm that what you've said is what is on the ground. And then 2, it also gives them areas where they can say, this is where the risks are. Am I willing to undertake that risk to create this sort of return? And then on top of all that, it can also impact valuation. So if your business is not well structured, then that ends up putting pressure, a downward pressure on your valuation. So this you can go through. Most critical, do a due diligence on your investor. It's not one way. You need to know who it is that you're dealing with. Find out what are their sources of capital. Are they mostly funded by DFIs? Are they mostly funded by maybe family offices? Because the source of capital has an impact in terms of some of the pressures they face in terms of return. What their typical investment process is, how long does it take, So find out also in terms of, maybe you have a 10-year fund life. I'm investing for 10 years. What year are you in? Because if I'm in year 5, likely I'll only be investing for year 5 and 6, because maybe 7, 8, 9, I'll need to be getting back or exiting from my investment. So you need to find that out. Do they currently have capital, or their fundraising? Some people engage with investors not knowing that these guys are still on the road looking for more capital. What instrument do they prefer and why? And how does this marry with what we discussed this morning in terms of your preferred instrument? In addition to money, what Vika said. He said, we don't really need money. Yeah, we need money, but there's something more important to us. So what else is he giving? And then get examples of what they've done for some of their clients. They should be, or investees, they should be able to tell you. This is important. We've all had breakups, right? So it's important to find out, have you ever had acrimonious issues, and why, what happened? Because there are always 2 sides to every story. Find out, and then what the process was. And then find out who is in their investment committee. Are they local people, or are they people who are based outside? The reason for that is if they're not local people, sometimes they lack the context of the opportunity. So you might end up going back and forth on something that they don't understand, not because they are not business people, but they lack that local context, and maybe that's something critical to your opportunity.